A chart of the general market. We're thrilled to do this with Charles Kantor of Neuberger Berman and look at the S&P 500 back when time began in the gorgeous upward trend. Review again, Charles, why somebody's long short in a market that's always moving higher. What's the benefit of long short given the perpetual bull market?
Well, we think that increasingly in the environment that we're in, there's a tremendous amount of opportunity on the short side. We're trying to deliver attractive risk-adjusted returns. We're running approximately net long in the 40 to 45% range. So if you like a smoother ride, we're trying to keep people wealthy and participate along the way. But it wouldn't be reasonable to expect us to participate in line with the market averages, given the fact that we're running with so much less net exposure. So we're trying to make attractive risk-adjusted returns. We're not trying to make the most of money.
Where's the most attractive short right now? It's been an ugly time for the pure shorts. Where do you find short value?
We've had a really good time of it this year on the short side. There's just, despite the overall calmness of the market as measured by the VIX, there's lots of bifurcation underneath the hood. And we spent a lot of time talking about the consumer discretionary sector this morning and the impact of Amazon and companies like that on other sectors. And we've had a really neat set of experiences in the consumer discretionary sector.
Charles, what is the biggest distortion out there? You talk about bifurcation. Does that mean that actually the market could go either way also?
I'm not sure if there is a big distortion as we see it today. No doubt there'll be a debate around that. But as I looked at some of the data, 2 years ago versus today, it's remarkable how despite so much change, the story's very much the same. Earnings, it's effectively earnings have trumped the rhetoric. And that's the story of the market over very, very long periods of time. Don't bet against the ingenuity of corporate America and their ability to reinvest cash flows around the world to reach attractive risk-adjusted returns. But the volatility levels, similar than 2 years ago, market multiple a little higher, earnings up a good amount, credit spreads about the same. So just because it's boring to say it's going to be more of the same, it doesn't mean it's wrong.
No.